What if I told you that one of the most hyped companies of the 21st century, Uber, spent over $33 billion, waged war against the taxi industry, and promised drivers and riders a revolution, but in the end, everyone lost. Uber's mission was to replace taxis, make rides cheap and easy, and empower drivers to earn more than ever before. But after more than a decade, the truth behind the promise is now clear. Uber's business model is broken, its finances are a disaster, drivers are exhausted, and the very system it tried to disrupt is now in chaos. In 2009, Uber burst onto the scene as a tech startup looking to solve an everyday problem: the pain of hailing a cab. With sleek branding, a user-friendly app, and massive VC backing, Uber was hailed as the future of urban transportation. Over the next decade, it would operate in more than 70 countries, attract over $25 billion in investment, and reach a peak valuation of $120 billion. But Uber wasn't profitable. In fact, it was burning cash at an alarming rate, losing $33 billion over its first 14 years. Behind the scenes, Uber was waging a brutal battle against traditional taxi systems, local regulations, and its own drivers. And while the company grew in size and global reach, it also left behind a trail of economic wreckage for riders, for workers, and even for its investors. In this video, we'll break down how Uber's grand plan failed everyone involved. Here are the 10 key reasons why Uber's $33 billion bet to replace taxis was a massive loss. For everyone, Uber's rise was built on subsidies. From the very beginning, Uber's explosive growth was built not on sustainable economics, but on deep financial subsidies. Uber deliberately charged customers less than the actual cost of the ride, covering the gap with investor money. Between 2010 and 2017, Uber raised around $13 billion in venture capital funding. These billions were used to subsidize cheap rides and pay drivers extra incentives to flood the market. It created an artificial perception. Uber appeared fast, cheap, and everywhere, but it was burning money to create that illusion. This strategy, often referred to as growth at any cost, meant that Uber was never profitable during its expansion phase. It used capital as a weapon to undercut the competition, primarily traditional taxis, but without any long-term business sustainability. The taxi industry was crushed, but nothing replaced it. Before Uber, the taxi industry was heavily regulated. Cities like New York required medallions, licenses to operate, which cost up to $1 million each at their peak. These medallions were often bought with life savings or taken out as loans by immigrant families. When Uber entered, it flooded cities with unregulated drivers, pushing down ride prices and wiping out the value of medallions. By 2020, medallions in NYC were worth as little as $100,000, bankrupting thousands of families. Many drivers, already deep in debt, committed suicide, unable to cope with their financial ruin. Uber had no interest in replacing the system it broke. It left behind an unregulated mess that benefited no one long-term. What was once a relatively stable job in the taxi world became a high-risk, low-pay hustle. Uber's gig workers are exploited. Uber marketed driving as the ultimate gig. Be your own boss. But the reality for most drivers is far from glamorous. They are classified as independent contractors, which means they receive no benefits, no health care, no paid leave, and no job security. A 2018 MIT study found that after expenses like gas, insurance, and maintenance, the median hourly wage for Uber drivers was just $3.37 to $8.55. This is well below the minimum wage in most U.S. cities. Furthermore, Uber consistently slashed driver pay to maintain low fares for riders. As competition increased, Uber introduced tactics like surge pricing and automated driver deactivations, which many drivers found manipulative or outright unfair. In many cities, drivers now strike regularly, protesting poor treatment and demanding rights as employees, but Uber continues to fight these classifications in court. The myth of cheap rides fell apart. During the early years of Uber, riders were able to go from point A to point B at a cost that was far lower than that of a taxi. It was quick, not just convenient, but it appeared to be revolutionary. On the other hand, those prices were not tenable. In response to the depletion of investor capital, Uber began to drastically increase its prices. Many riders stated that Uber had grown more expensive than taxis in 2023 and 2024, particularly during peak hours. This was notably the case during rush hour. Previously, a journey would cost $12, but today it would cost at least $25 or more. It has been reported by Bloomberg that the average cost of an Uber ride increased by more than 80% between the years 2018 and 2023 in major cities such as New York, London, and San Francisco. As a result, the primary promise, which was that the service would be cheaper than taxis, turned out to be a short-term strategy to gain market share. Uber burned $33 billion and still lost money. The losses taken by Uber are enormous. In the period between 2009 and 2023, Uber racked up net losses totaling more than $33 billion, making it one of the most unprofitable technology businesses in the history of the industry. The following is a brief summary. In 2019, Uber suffered a loss of $8.5 billion the year it went public. The loss in 2020 is $6.7 billion. The deficit in 2021 is $2.8 billion. 2022, a loss of $9.1 billion as a result of drops in stock prices and investments. Uber has never had the opportunity to achieve true and continuous profitability from its primary business, which is ride-hailing, despite the fact that it has raised more than $25 billion in capital. The adjusted EBITDA profitability, which is a non-GAAP number, was just recently declared by the company, yet it continues to report net financial losses. The autonomous vehicle bet failed spectacularly. One of Uber's biggest hopes for turning profitable was removing its biggest cost, the driver. Uber invested over $2.5 billion into self-driving car technology, believing it could create a fleet of autonomous vehicles that would cut labor costs entirely. But the project hit roadblocks, including multiple crashes, technical failures, and a fatal accident in 2018 where an Uber self-driving car struck and killed a pedestrian. By 2020, Uber gave up. It sold its entire autonomous driving unit, ATG, Advanced Technologies Group, to Aurora Innovation. This marked a total surrender in the driverless race and another billion-dollar loss. The dream that tech would magically make Uber profitable just didn't happen. Uber Eats was a lifeline, but not a savior. Uber made a desperate attempt to diversify its business by increasing its focus on food delivery. Launched in 2014, Uber Eats quickly became the branch of the company that experienced the most rapid expansion, particularly during the epidemic. Nevertheless, the business of delivering meals is just as cutthroat. Uber Eats also operated at a loss for a number of years due to the fierce competition that it faced from companies such as DoorDash, Grubhub, Deliveroo, and others. It wasn't until 2023 that Uber Eats reported an adjusted profit, but the margins were extremely narrow, and the division is still unable to compensate for the losses that Uber's core ride company has incurred. Concerns over the exploitation of workers, opposition from restaurants on the costs, and legal scrutiny in a number of countries were also experienced by Uber Eats. It was not a solution, rather it was a lifeline. Cities and regulations are catching up. The initial plan for Uber was to begin operations first and then attempt to appeal for forgiveness afterward. It began operations without obtaining licenses in city after city, which resulted in legal conflicts and demonstrations. By 2024, however, a great number of cities are fighting back. It was the intention of California's Assembly Bill 5 to categorize drivers as employees. Uber drivers must be classified as workers and receive benefits, according to a ruling from the Supreme Court of the United Kingdom. For the purpose of regulating gig employment, the European Union proposed new laws. In addition, cities are strictly enforcing minimum wage rates, restrictions on the number of vehicles, and obligations for data sharing. The free-for-all environment that Uber previously exploited is no longer the context in which it operates, and the company is having a difficult time adjusting to the expense of compliance. Investors are still waiting for returns. May 2019 marked the month when Uber went public with a valuation of $82 billion. Its market value dropped by $1.6 billion on the very first day it was traded. Speculation, rather than excellent fundamentals, has been the primary driver of the stock's ups and downs, which have occurred since that time. A great number of early investors had high hopes for a technological miracle. On the other hand, they have experienced losses from the previous year, dilution of their shares, and missed predictions. The stock of Uber has only just begun to recover by the year 2024, but it is still trading at a rate that is significantly lower than what many long-term investors anticipated it would be. Uber has not delivered steady profits. Rather, it has only delivered volatility. This is despite the fact that the firm has pledged to be the Amazon of transportation. Uber was supposed to be a revolution, a sleek app, a global brand, and a promise to fix transportation forever. But after more than a decade, Uber has burned $33 billion, disrupted lives, and left drivers and riders both worse off. The dream was sold, but the reality never delivered. Thanks for watching. If you found this breakdown eye-opening, don't forget to like, subscribe, and click the bell icon for more deep dives into the rise and fall of the world's most talked about tech empires.